Thank you. Thank you very much, Ryan. And welcome to our special digital event tonight, where we're going to discuss the AAII Way, and we're going to update a member specifically on the asset allocation portion of this particular product. My name is John Bykowski, and as Ryan indicated, I'll be serving as a moderator tonight. But most importantly, I'd like to introduce you to Charles Rotblut. He is the Vice President at the American Association of Individual Investors. He's also editor of the AAII Journal, and he's the lead writer for the VMQ Stocks service. Charles, welcome.
Thank you, John. It's great to see you.
Yeah, tell us a little bit about what you'll be talking about tonight, so we can whet the appetite of our audience.
Absolutely. So the AAII Way is a process for everyone listening, and really for all AAII members, to create their own investment policy statement. It's basically a framework governing how your portfolio is going to be managed, from defining why money is important to you, what are you investing for, all the way through the process of how you're going to construct your portfolio, how you're going to manage it, what's going to go into it, down to the review process, and actually the estate planning. And near the end of this presentation, I'll show everyone the worksheets we've created so far and give them a preview of some of the prototypes we're working on, so they can see what the full process is going to look like. But the overall idea is to give you a plan, a set of documents that you can rely on, so when you get nervous about the market, you have this plan you can fall back on and continue to make systematic decisions about your portfolio.
I still remember going back early on this year when this project was in its infancy, and it really grew about out of our desire to come up with some, we'll call it onboarding material for our members. And we have developed material when someone becomes a member to kind of show them what's available as part of their membership. And we thought, what really we needed here was a path for people to follow, whether you're a new investor or an advanced investor, whether you have a financial plan or not. But how has this process or this thought changed over time, Charles?
Yeah, it's really developed, and we have a lot of just great and valuable information and data on AAII, as you know. And it's kind of, I'm going to actually tie this back to our founder and chairman, Jim Clunan. His two rules of success are: one, have a well-defined approach to investing, and rule number two is always remember rule number one. And this really was a process when we looked at all the great information we had. How can we give people a process to actually combine it into a single plan they can actually apply to their portfolio? So this is really building on everything that AI offers and tying it all into one document, so someone can come to our site and, regardless of their investing strategy, say, okay, I have this master plan, and now I can take the bits of AI membership that really fit into me as an investor and apply it to my own portfolio. So it's really almost the ribbon and the bow that ties everything together into a comprehensive document for our members.
I remember, trying to use a big whiteboard. We found the biggest whiteboard we could in the office to kind of try to map this whole process out. But one thing I think that we saw that was a need for from the beginning was a feedback loop from our members. And how has we decided to, rather than throw it out at once, introduce it at once, really kind of develop it and present it over time. How has the feedback helped you in this process?
Oh, it's been great. It's been interesting to hear back from members, both praise and also suggestions. Why don't you do this? Why don't you do that? Our risk questionnaire was revised. The first version we put out there, someone said, hey, a few people said, can you do this? Can you do that? So we changed it. Another thing is our goals worksheet. One of our members wrote back saying, what you did was really great, but I really want to have a field to add comments. So we created that for our worksheets. We're now offering Excel downloads. That's coming from member feedback. So I really appreciate hearing back from members, because you obviously have great ideas. I have ideas on my own, but we want this to be usable. We want our members to say, yeah, this is really what I need. And if they see something that we missed, or perhaps they have a thought that we didn't think of, we'd love to hear it. We want this to be a product that actually exists for members versus us just saying, here's our creation, use it.
Well, I'm going to fade into the background, and I'll be listening to what people are having to say as far as their questions. So as a reminder to everybody who joined us, we are recording this webinar. An email will be sent out tomorrow with links on how to get access to the webinar recording. I'll be looking at the questions. Please submit them in the questions area. And Charles will stop periodically during the course of his presentation tonight to do his best job to answer them. So thank you very much, Charles, and take it away.
Thank you, John, and good evening, everybody. Thanks for joining us. Those down on the path of the storms on the Gulf Coast, hope you're staying safe. I'm a former Houstonian, so I'm obviously watching the storms closely and hoping my friends down there are all staying safe and hopefully their houses will stay completely dry. But tonight we're going to talk about the AAII Way, something a little bit happier, and something we do have control over, which is how we manage our allocations. And as John introduced this is a new project that's really designed to help you create a comprehensive plan for investing. And the real idea here is to help you become a more effective manager of your own assets, which is what AAII exists to do. And this aspect is to help you really make more repetitive, more systematic decisions, to really have a path you can follow instead of trying to worry about what's going on with the market, instead of wondering what the pundit's telling you should do. It really comes down to what goals are you trying to achieve and what do you have to do to make sure those goals are achieved, or at least increase your odds so that your odds of achieving those goals are as high as they reasonably can be, given your tolerance for risk and given your personal constraints. And it's a 5-step process to managing your portfolio. It's defining your goals and needs. Above everything else, it really comes down to, why is money important? Why are you investing? Why are you saving? Is it to fund retirement? Is it to leave money for your heirs? Pay for a grandchild's education? Or perhaps if you're younger, perhaps you're trying to build up your savings so you can retire someday, perhaps to buy a house. Perhaps, it's something more material. Whatever it is, it's your goals and what's important to you. So that really drives everything else. And from there, we want you to pick an allocation, which we'll talk about today, identifying your investing preferences, select investments, and then it really comes down to the monitoring process, reviewing your portfolio. Do changes need to happen? But also monitoring your life. Has a big change happened in your life stage? Retired, divorced, illness, birth, happy events, and obviously sad events. But those big events can influence how you allocate. It can obviously also change your goals and what's important to you. So what is this going to accomplish? It's a series of worksheets we've been unveiling at AAII.com/AAII Way. You can go on them right now. You can see all the worksheets we've created, all the commentary I've written about the process so far. You'll be able to try, if you haven't been there, you'll be able to try things out. You'll be able to leave comments. If you haven't been there, I encourage you to do so and actually read through it and try out the worksheets. I'm doing commentaries, my weekly AAII Investor Update emails. You'll see those commentaries at the aforementioned link. You can also simply click on the latest tab on any page on AAII and actually get to Investor Updates. We're publishing worksheets, revised worksheets in the AAII Journal. In the forthcoming September journal, you'll actually see the asset allocation models, which I'll be talking about today. That'll be up on our website next week. But you could go to the homepage of AAII.com and actually see a preview of some of the articles we're going to have available in the September issue. In longer term, we're thinking about actually coming up with a new book, really tying everything in together and providing deeper explanations and more color on the process. And we want to fully integrate this into AAII as well, so that you can really see how this ties into everything else you're doing on AAII, on AAII.com. And then for those of you who are new to this, who haven't actually been reading the materials or missed my first webinar, you can actually go to AAII.com and see the first webinar, which John mentioned. And you can also see all of our previous webinars as well. We've been doing these now for several months during the pandemic. We've had some great presentations. both by my fellow colleagues. We've also had some great guests from outside the organization join us as well. But tonight we're going to talk about asset allocation. That's what we're going to start about. Asset allocation is really what's in your portfolio. What main asset classes are you allocating to? And it can be a variety of assets, but where most people really screw up in investing isn't that they're not picking the right stock or they're missing out on the right fund. It's they do not get the proper mix of stocks, bonds, and cash correct over the long term. If you can just get those three asset classes, get the appropriate mix of stocks, bonds, and cash that's correct given your goals, given your investing time horizon, and given your tolerance for risk. If you can just figure out what that is and stick to that plan over the long term, you're going to have returns far above the average investor. And it's not just individual investors. We see this institutional investors too, constantly jumping strategies. If you really just tune everybody out and just really think about what's the right allocation given my time horizon, given my goals, and given my tolerance for risk, that's really going to help you. And we're going to talk about that tonight. And I think it's really important to realize where mistakes are made is that people try to do too much. They focus too much on return. They focus too much on short-term events, what's going to happen with the coronavirus, what's going to happen with the election, what's going to happen with interest rates, focusing on too many things that are front and center in their mind, and they lose sight of the bigger picture. Why am I investing? How far away is that goal? What do I need to accomplish that goal? So it's really not the things that people want you to think about or about the things that necessarily come to mind first. It's really about what's right for you and what are you trying to accomplish with your money. And I realize it can be very tempting to focus on these things. And it's always this urge to wait for the all clear sign when there aren't risks. But the problem is if you wait for the all clear sign, if you wait for that time where valuations are great, there aren't potential macro headwinds that you can foresee down the line, that you see that business is doing well, you see your neighbors are doing well. Those times rarely exist. It's really hard to get that perfect combination. And as investors, we get compensated for that risk. In fact, our founder, Jim Clunan, used to refer to volatility as phantom risk because it really is the price you're paying to get long-term appreciation in your assets. It's really the price you're paying to grow your portfolio over time so you can build wealth. So although it's tempting and although it's really hard sometimes to ignore some of these big events that are happening, and certainly we have them in a very large amount this year, you really want to try to focus on a plan and not the day-to-day news events. It will make you a better investor. So one of the things you can do is focus on your allocation. And to help you do this, if you're wondering, well, that's great, Charles, can you give me some suggestions? Well, in AAII, for a long time, we've been providing these asset allocation models, an aggressive, a moderate, and a conservative. Now, these are just models, and these are based on long-term performance of the markets. So they're good models, but allocation is a very personal decision. And we're going to talk about allocation today, but realize you do need to tailor it. And while we can give you examples of allocations that work well over the long term, you do need to consider your own personal situation and what works best for you. So these have been our long-standing models. And what we've actually done with the AAII Way, we revised them. Specifically, we've taken our moderate and our conservative allocations and made them a little bit more conservative. And tonight, I'm going to explain why. Now on the slide, and you will see this in the September AAII journal as well, you can actually see the changes we've made to it. We've lowered our exposure to mid-cap stocks. We've lowered our exposure to emerging markets. We've increased our exposure to short-term bonds. But on a bigger picture, if you take a step back and really look at what we've done, is we've taken this portfolio that was 70% stocks, 30% bonds, and made it 60% stocks, 40% bonds. So not a wholesale change, but really we kind of took the dial, tweaked it a little bit. So the question obviously is, why? And one of the reasons is we looked at the data, and 60/40 happens to be a very well-established benchmark. It's been used over a long time. It can be implemented very low cost. If you want the traditional version of a 60/40 portfolio, you simply buy an S&P 500 fund or a diversified total market fund and a diversified bond fund. That'll give you a 60/40 allocation. You can do that with ETFs or even Vanguard Admiral funds and expense ratios of less than literally 0.01%. Really cheap, or sorry, I should say 1/10 of a percentage point. You can get this done really cheap if you wanted to. But what I want to point out is our decision for doing this was not only realizing that 60/40 is this well-established benchmark, and we've seen it used over the long term. In fact, Vanguard's Wellington Fund, which is started around 1929, uses this approximate benchmark. Jack Bogle was close to using it, the founder of Vanguard. Harry Markowitz, who came up with the efficient market theory, which guides a lot of investing decisions. It came up with the efficient frontier, which basically says there's an optimal amount of risk you should be taking with your portfolio for a given level of return. His portfolio is pretty close to the 60/40 mix. He's actually 50/50. So there's a lot of historical basis behind this, both from academics, from industry, and from research. But I do want to point out that we're not making a forecast on the market. We're not saying, you know what, we expect stock returns to be worse going forward. We're not saying we think bonds are going to be stable. We're actually not making any market forecasts. We're really just looking at the data, trying to find a model we think that's truly a moderate allocation, really trying to draw a bigger differential between aggressive and moderate. And the other thing I said about 60/40, it's also just easy to follow. But the one thing I will point out, you notice this last bullet point, that's worked well over long time spans. And even over 40-year periods, I've tested this with a 4% withdrawal rate. And even over 40 years, if you follow the Benyon 4% withdrawal rule, which says on the day you're retired, calculate your portfolio balance, calculate what 4% of that portfolio balance is, that's your starting amount. So say you retire with $1 million. Your first year's withdrawal will be 4% of that, which is $40,000. Every year you actually adjust that $40,000 by the rate of inflation. So start with $40,000. Just to make the math easy, say next year's inflation is 5%. You increase that $40,000 withdrawal by inflation, that's 5%. So year two's withdrawal is $42,000. Using that 4% rule, even at 40 years, this 60/40 mix of just the really simple version of it has worked about 87% of the time, meaning 87% of all rolling 40-year periods, your portfolio would have never run out of money. So we do have there's a lot of data out there showing you that 60/40 actually does work as a benchmark. Now, is this going to give you stellar returns year in, year out? Absolutely not. Is this going to be the strategy you're going to be able to ship at cocktail parties when you're able to get back together and say, man, you're not going to believe how well my portfolio is doing at 60/40? It's not that either. It's not that either. This is moderate, a moderate balance of return and risk. And so the obvious question is, okay, you're saying this, what is this going to do to the returns? So we recreated the portfolio, this moderate allocation portfolio. We did this with using indexes to see what would have happened over the last 20 years, going all the way through 2009. And so what we found out was that annualized returns went down a little bit. Not surprising. You reduce your exposure to your riskiest assets, and particularly to your best performing assets, which in this case is stocks, you're going to lose some return. But if you look at the next row, standard deviation, that dropped further. So we had about a 10% roughly decrease in actual annualized returns, but we had about 20% drop in volatility. So standard deviation in this case is the volatility of the annual returns. So we gave up a little bit off the top in terms of returns, but we also gave investors potentially more ability to sleep at night. And so there's always this balance that if you want to have less risk, you have to give up some return, but if giving up some of that volatility allows you to stick with your portfolio for a longer period of time and stick with allocation more consistently, you may end up with better returns because you're able to follow the allocation. It's a more optimal allocation. And as you can see on the slide, the lowest return actually did better. This is 2008 for the revised model versus the current model, reduced risk, so our downside was less. There's still downside, there's still the possibility of negative years, but the downside is just less. So the other big question people are having, they're suggesting the bond allocation increases at a time that bond interest rates are really low. Yes, I looked at 10-year yields yesterday. I think they were about 0.5%, maybe 0.7% for the 10-year, painfully low. And yes, bond yields are low, and we're not making a forecast. The Fed right now is saying they're going to keep interest rates where they are probably till 2022. Could that change? Absolutely. But I think you'd have to realize that right now, we have the Fed's target for interest rates is at 0.0% to 0.25%. If you're worried about a return of, say, 1970s bond yields, or certainly where bond yields were when Paul Volcker really slammed the brakes on inflation, we're a really long way from that. In fact, John and I had a conversation earlier this week about bond yields, and really, if you go since about 2011, you call up a chart of 10-year yields, you can get a mark and draw a line right at 3%. That's been a pretty strong resistance line. So even just to get up near that 3% would, at this point, would require a pretty big move in bonds. But I did look at the performance of the portfolio historically of the 60-40 mix to see what would have happened. And since 1929, there's only been one 20-year period where bond returns annualized have stayed below 3% for most of the time. And that was this period of 1940 through 1959. And there were 13 years when the returns on intermediate term bonds were really low. And during that period, the 60-40 portfolio realized close to a 10% return. How's this possible? Well, it was the stock portion that was driving the portfolio. So over that period, stocks actually did quite well. Were there some bumps on the road? Absolutely. There's some recessions, and obviously we had World War II over that period. But by and large, it was coming out of the recession, out of the Great Depression, to be fair, but it was a good time. But it was interesting. So I did look at the history of the 60-40 portfolio, not the allocation we're prescribing, but really this mix of just large cap, intermediate term bonds, just to draw the distinction. But during that period, most of the time when the portfolio had a negative return, it was because of the stocks, not because of the bonds, because even at 60-40, most of your volatility in returns is still being driven by the stock side, because the portfolio itself is tilted towards equities, and equities are more volatile than bonds. And what's interesting is that even during years where bonds weren't doing well, bonds still help buffer the volatility of stocks. So one way to think about bonds is there's an old adage in investing that bonds give you the courage to invest in stocks. And so the whole idea for holding bonds is it's really a safe asset. It's really a buffer against volatility. Now our 60-40 model uses intermediate and short-term bonds, not long-term bonds. When I look at the returns right now, I think if you're particularly using bond funds, I don't necessarily think that you're getting enough excess return versus the interest rate risk from going out on long-term bonds. Now, if you're laddering, that changes the story, because if you're laddered bonds, what it means is you're buying bonds with different maturities. So maybe you buy a 2-year, a 5-year, a 7-year, a 10-year. Maybe you go out even further than that, etc. But the idea is your bonds are maturing at different times. So then you can, as those bonds mature, you can then reinvest them at different interest rates. Now, if you don't want to hold individual bonds, there are defined maturity bond funds. These are managed funds. These are actual mutual funds and ETFs. So they trade just like mutual funds. They're professionally managed just like mutual funds and ETFs, but they're actual funds that will mature on a certain date. In our show notes, we'll post a link to the article so you can actually read about them and understand how they work. But you can ladder those. So if you're worried about interest rate risk, you can actually ladder those by different maturity dates to actually smooth out the volatility. Now, I will say that because our bonds are intended to be a buffer against volatility, if you're looking at this and you're going, no way, Charles, am I touching bonds? That's fine. Again, we're providing models. It's up to you to apply these models or to use these models as a basis to find an allocation that works right for you. You could substitute CDs. So if you're really nervous about interest rates and you really think the interest rates are going to take a sharp rise, you could potentially look at CDs. But the other thing I'll tell you, when you're looking at bonds just in general, regardless if you're looking at individual bonds, you're looking at bond mutual funds, bond ETFs, look really for investment grade. Look at your investment grade corporate bonds, your treasury bonds, obviously are investment grade, or your municipal bonds. When you see actively managed bond funds, or you see other bond funds that have higher returns, it may mean that they're taking on more credit risk. So credit risk is really the risk of default. What is the likelihood that the bond issuer is going to default on its bonds and not make its interest rates? The higher its risk, the higher its yield. In bonds, if you see higher yields, it means one of two things. A, the duration of the bond's longer, meaning it generally means there's a longer time before that bond matures, which means there's more interest rate sensitivity, which means the bond price will move more relative to rates and fluctuations in interest rates. Or B, there's credit risk, which means there's a greater chance that the bond issuer could default. It doesn't mean the bond issuer will default, but there's a greater risk of it happening. So in bonds, there really isn't a free lunch. A lot of times you're getting what you're paying for. Sometimes if you look, you can snag a free dessert if you really understand how to analyze bonds. But in general, you really want to stick with safer bonds, even though their interest rates are low. And I realize at this point, painfully low. These are intended to be the safer part of your portfolio. Now, for a conservative portfolio, we went from 50% stocks, 50% bonds, down to 40% stocks, 60% bonds. In this case, we actually increased our exposure to short-term bonds. We also decreased our exposure to short-term stocks. We actually have a little bit more international stocks to give you a little more diversification in the portfolio. But the idea here is really just to make this more of a truly conservative portfolio. So this is a portfolio that's still designed to provide growth in capital, but we want to provide a little bit more asset preservation, less volatility. So this is really for someone who has a shorter time horizon, or for someone who's really nervous about the market and really is not in a position to withstand a lot of volatility. So we really wanted to make this more of a true conservative portfolio. And again, we're not making a forecast on the market. A lot of people are trying to say what's going to happen this year, what's going to happen next year. The reality is, if you go back, even start of 2019, no one in 2019 was saying, in 2020 is going to be a bear market, interest rates are going to be down near 0%, sweeping pandemic happening, two tropical storms in the Gulf of Mexico. No one was predicting that. And so while a lot of people like to make predictions, the truth of the matter is random events can and do occur. So even if you can predict short-term events with a high degree of accuracy, it doesn't mean you really have the ability to see around the corner and see what's even going to occur 18 to 24 months from now. So again, this is not a market call. This really is a call when we're looking at allocations, people's risk tolerances and their goals, and really trying to get our models to match what people are actually going to have and face in terms of making their own portfolio decisions. And so you can see here with the conservative portfolio, again, lower return, but less volatility. So again, the idea was to tone down the risk to make the allocation easier to stick with, because the allocation you can stick with can give you higher returns than an allocation that might have a higher long-term payoff by the numbers, but you can't stick with it. Now, with our aggressive allocation model, we left it as is. So this is basically 90% stock, 10% bond allocation. And our aggressive model, as you can see here, calls for a very diversified portfolio of stocks. So large cap, mid cap, small cap, international, emerging. The idea is this is really designed to achieve a lot of return, but also diversifying your stock portfolio over a variety of assets. Now, I do want to say you don't necessarily have to follow this model. You could actually use Jim Clunan's level 3 approach. For those of you who read Jim Clunan's book, he offered two strategies. One, if you're going to be an active stock picker, you can follow his shadow stock portfolio. Alternatively, you could also use one of our own other portfolios or a mix, our dividend investing portfolio, our stock superstars, our VMQ. In fact, you could take those portfolios and actually match them to the shadow stock portfolio, because by and large, they don't overlap very much, because our shadow stock portfolio really hones in on microcap, deep value stocks. But your other option is, if you prefer ETFs, Jim Clunan's passive level 3 portfolio. You could actually use that, and we'll be talking about that as well in the AI journal. For the bond allocation, this really is a safe portion of your assets. So you really could, if you don't want to hold bonds, think about CDs. Alternatively, going back to Jim Clunan's level 3 book, and if you're retired, you could think about Jim Clunan's withdrawal strategy, which calls for 2 to 4 years of living expenses and riskless assets, so really safe assets. So how much money do you need to live over the next 2 to 4 years? If you're in a position where maybe you're really young, you have a pretty strong set of cash flow from your job, you could think about what do you need to cover your emergency expenses. Maybe it's 6 months, as a lot of advisors to have. Maybe it's 1 year, maybe it's 2 years. But again, the idea of this bond allocation isn't so much about bonds. It's more really a matter that I'm going to be very aggressive with stocks, but I want to have this buffer so when there is a bear market or the markets get turbulent, I need cash flow. I'm going to have this bucket of cash off to the side, so I don't need to sell stocks when the markets are down. I can leave my portfolio alone and give it the chance to recover without making withdrawals from it. So John, I'm going to pause here for a second and see if there's any questions that have come through that you'd like to share from our audience.
Charles, the questions have been coming in, fast and furious here. So I'll do my best to give you a summary. But how much time do you want to allocate for questions?
Why don't we go about 10 or so minutes, and then I'll go through worksheets, and we'll have time afterwards.
Very good. This is it's kind of an overview question. But if there was one book you'd recommend that can serve as a Bible to guide the newcomer investor, which book would it be?
One book, that's really tough. I always go back to Benjamin Graham's The Intelligent Investor. Not only is it about value investing, but it's about the markets. And I think he also talks a lot about how you should approach an investor and your mindsets. So I think that's a really good book. If that person were to allow me to suggest one other book, I would actually suggest The Undoing Project by Michael Lewis, which really takes Daniel Kahneman's research into behavioral finance and really makes it a really good, clear manner for the layperson to understand. And I think as an investor, if you understand value investing and you understand the importance of controlling your emotion, that alone will give you an incredible edge over many investors.
Thank you. At the beginning of the presentation, you mentioned allocation consisting of stocks, bonds, and cash. But in the allocation models, there is no cash allocation. Is that intentional, or is cash part of fixed income?
So you can treat cash part of fixed income, but we did treat intentionally. Our models are actually designed for your investable assets. And so there's definitely discussions about whether or not your cash savings should be part of your portfolio. You'll see in the worksheets, we did include it. We view this as your investable assets and how you're going to handle your investable assets. So we kind of view as your cash that you need for emergency savings as being separate from your portfolio.
You know, moderate allocation may be fine for some folks, but as a result of the pandemic, many like myself will have to retire early because of layoffs. Therefore, we may need a more aggressive allocation to fund the retirement. A couple other questions have to deal with kind of that concern, is that what kind of allocation is appropriate given our more economic situation today?
Yeah, it's interesting because I have looked at withdrawal rates, and I've actually done research. We can point to these in our show notes, the articles, where the 4% withdrawal rate tends to fail. Well, it fails for two reasons. One, if you take too high of percentage withdrawal rate, that's a recipe for disaster. The other thing, when there's been bear markets early on. And what I would encourage people to realize that if you take a more aggressive stance once you're retired, you don't necessarily have time to recover should there be another bear market that sets you further behind. One thing you may want to think about is, do you have the ability to adjust your withdrawal rates? Vanguard's done some research into it, and what they figured out was that the more you can actually lower your withdrawal rates during bear markets, so instead of saying taking 4%, if you have the ability to say take 3%, or just really whatever that amount is, the more you can time your budgets during those bear market periods, the better your odds of success are. The whole idea for having a bond allocation, the whole idea for maybe having a cash portion, to use Jim Clinton's level 3 approach, is to not sell your stocks during your retirement years, during those down markets, allow them time to recover. If you really feel like the only way you're going to get back is to be more aggressive, that's certainly an option. I would encourage you to perhaps think about, other options. Could you possibly consider doing some work? Obviously, several factors to be involved with it, but certainly having a bear market hit early in retirement is certainly a tough thing, and there isn't always easy answers to it, or answers that are comfortable to give when that happens.
A number of members are concerned that interest rates are very low now, and there is a known inverse relationship between, direction of interest rates and bond prices. Any thoughts as far as and stocks may not perform the same in the future as they have in the past? Any concerns about relying too much on historical data to model future behavior? And also any thoughts about investing in a low interest rate environment?
No, that's a great question, and I did pose it to Roger Ibbotson. And for those of you not familiar with Roger Ibbotson, he's a market historian. For years he's been publishing this book, which is known simply as the SBBI. It covers stocks, bonds, inflation. And I had a chance last year actually to ask him about this, and he said, when you look at the 60-40 allocation, he's like, if someone were to ask you about it, he's like, going forward, I would probably assume 0% return on the bonds, and then just what you get on the stock side would be your return from it. But he did say that doesn't mean that bonds don't have a purpose. And again, the reason with bonds is they're a volatility buffer against stocks. And I think it's worth noting that we could see a period where bond interest rates stay low. So maybe they do go up from here, but they stay low. So yeah, bonds and interest rates are inverse related. When you look at things like funds, they will reallocate back to the higher yielding bonds eventually. You can ladder and you'll be able to reinvest those higher yielding bonds although even though the yields will still be low. And it could be perhaps stocks. We'll see what happens. But the thing is, if you're going to start adjusting your portfolio based on a certain outcome, realize we don't know right now. We're looking at a situation like Japan where interest rates stay really low for a long period of time. Are we going to have this V-shaped extended recovery in the markets where stocks really take off and we see interest rates jump? Or do we actually start to possibly see negative yields in the US? The real answer is we don't know. And our reason right now is looking at long-term data is all we have to go off are the historical odds. And if you're not going off the historical odds, then you're making a tactical decision that somehow they're not going to tell you anything about what's going to happen in the future. And then you're making a market forecast and a tactical decision, which you can do, but realize you do have the risk of veering away from what the historical odds are to invest on based on what you think might happen.
How often is an asset allocation review supposed to be done or recommended? Is there a minimum frequency or is it event driven?
You can do it both ways. We suggest doing a portfolio allocation, a comprehensive one, about once a year. It depends on your strategy. If you're someone who wants to rebalance your portfolio, perhaps if your allocations and there's big swings in the market, and you notice your allocation getting off kilter, say you do have the 60-40 allocation, and suddenly you realize your stocks allocations are now 66% instead of 60%. You could do that every 6 months. I think the big key is to really have those rules written down saying that I'm going to review my allocation X period of time and make sure you stick to it. Now, I will say, but you do also want to think about big life events. If something changes, a big life stage changes, say you get retired, say grandchildren are born, you get married, there's a job loss, that would be a reason to revisit your allocation. Or should one of your goals change? For instance, say your goal was to fund retirement and you get 20% above it. At that point, you may want to take a look at your portfolio and start thinking, you know what, I have this goal realized. Maybe I want to think about the other goal. And I will say there's a discussion of finance. We don't address this yet in AAII Way. There is this discussion of finance about target wealth, that if you reach your target, at that point, you de-risk with that money you have for your target and just leave it safely invested and then focus on other things. So not one answer, but what I would encourage people to do is think systematically. If they want a simple answer, I'll say do it once a year and have a specific reason for why you do it. And the AAII Way will help you build your rules for how you will actually do that review process.
2 more questions, and I'll let you continue. Are dividend-paying stocks, can you consider them to be a bond equivalent in this market environment?
I do not, and I realize that a lot of people are looking at them because they do pay higher yields. Dividend stocks, even though as a group they might be less volatile than stocks, they're still more volatile than bonds. And so our rationale for bonds and these allocations is really to be that low volatility buffer. So although a dividend stock might be less volatile than, say, a stock like NVIDIA or some of these other high-flying, Tesla will point out, they're still more volatile than bonds. So the idea of bonds is really to have this low correlation. And we know over the long term, bonds are pretty much uncorrelated with stocks. So their returns move really independently of stocks. And so from that standpoint, I would say no. Now, if you're viewing this fully as an income viewpoint and volatility, your idea is I'll take higher volatility, I'm more concerned with income, then that's a completely different discussion than what I'm having right here and what I'm saying right now.
When it comes to the time horizon for these various asset allocation models you're presenting, is there a minimum time horizon for like a moderate or aggressive or conservative portfolio?
Yeah, there is, and we're in the process right now of revising what's on the website. And I went through the data. I showed it to John. Derek Hageman and Wayne Thorpe, we're suggesting conservative is for investors, the investment horizons of 10 years or over, moderates 15 years or longer, aggressives 20 years or longer. Now you could actually shorten those. The conservative allocation, when you ran the numbers, you pretty much did not see losses for periods of 6 years or longer. If you're willing to withstand a little bit of volatility, perhaps some down years, you could actually say conservative for periods of 5 years or longer, moderate of 10 years or longer, and aggressive for 15 years or longer. We're actually going to go with a little bit safer, a little bit more conservative. So it does depend on your willingness to withstand some occasional losses in these allocation models. But I think the big thing to realize that if your time horizon in terms of pulling money out of your portfolio is really 5 years or less, or even 4 years or less, that money really shouldn't be invested in stocks, because if you have an ill-timed bear market and it's money you absolutely need to spend, then you may not have that money at the time that you need to withdraw it. And Jim Clinton, that's really how you define risk. Will you have the money you need at the time you need to withdraw it? So that's one way to think about these models and how we're kind of viewing the time horizons for these various allocation models.
Well, thank you. These are, again, great questions from our members, and you've got very good answers. So for the next part of your presentation, you're going to get involved in discussing the workshop, the various worksheets you've developed, and then you'll save some time at the end as well for additional questions and answers. Is that correct?
That's correct, John.
Very good. So I'll fade back into the background again, and I'll be monitoring the questions panel for questions.
Great. Thank you, John.
Welcome.
Thanks for all the questions. So now I'm going to actually show you the worksheets for AAII, for the AAII Way. So you actually get to see what we've done and what we're doing. And so you actually get to see what this process is going to look like. And as I said, we're soliciting member feedback. So as you go through this, you'll be able to see the finished ones. They're all available on AAII.com and AAII Way. The prototypes are still developing, but go through them just saying, you know what, Charles, that works really well, but it'd be great if you did this, or have you thought about that? We definitely want this to be used by members. So I certainly welcome your feedback. So to start off with the worksheets we've created, the whole process again starts with identifying and prioritizing your goals. Why is money important? What are you investing for? And we want you to list your goals and prioritize them. And so this is for a hypothetical couple we've come up with, and they're retired, and you can actually see on the sheets what their goals are. And so the idea is whatever goal is on top, that's the goal you have to fund no matter what. So if push comes to shove and you can only achieve one goal, what would that be? And that's why we want you to prioritize them. Now, again, you'll notice on the right side, the comments section. I mentioned this earlier in the presentation. That wasn't on the original version of this. This was actually a suggestion by a member to add this. So after you identified your goals and prioritize them, we then want you to define your tolerance for risk. And this is just part of the questionnaire. And we did redo the original version of the questionnaire to this revised version. And we're really looking at your time horizon and then your financial and tolerance for risk. So you see your tolerance for risk, but we're also looking at when you need the money and how much money do you need relative to your assets. So I just talked about time horizons. But the key is, if you have a lot of cash flow, you can take more risk. So you're not seeing this on the slide. It's really in the other part of this risk questionnaire. But say you're retired and you've got you're fortunate to have a pension, and you've got good Social Security benefits. Well, even though you might need to take some withdrawals out of your portfolio for RMDs, you may be in a position where really you don't need that money and you can invest it for your heirs. So in that case, you could actually be really aggressive. So even though you might have to sell some stocks to do those RMDs, you're able to take those RMDs as soon as you make those withdrawals and put them back in the market because you do not need the cash flow right now. So part of risk is really how much cash do you need relative to the size of your portfolio. And after you define your goal, after you figure out what your goals are, and your tolerance for risk, that's where asset allocation comes into. So what am I trying to do? How far away is it? How much risk can I stand based on the risk questionnaire? And then what is the right allocation for me? Based on what I've said, am I aggressive? Am I a moderate? Or am I a conservative investor? And you may go through this and you may realize that you think you're one type of investor, get to it and realize that you're actually something else, in which case you might want to look at the documents and say, okay, where's this disconnect? You know, did I answer something wrong? Or do you know what? I know I said this, but I fundamentally believe that I can handle more risk than what everything's saying. Or maybe you believe, you know what? Yeah, maybe I can't handle as much risk as I originally thought. You know, again, this is a personalized decision. Then we want to start thinking about, well, how do you actually take all this and implement to a portfolio? And we want you to think about how you want your portfolio to be managed. And this really comes down to what type of investor are you? We know many AAII members are what I like to describe as hands-on investors, rolling up your sleeve, do it yourself, or you want to be in charge of everything and pick everything yourself. You want to analyze all the securities, be complete save what goes in your portfolio, and that's great. I love doing stock analysis myself. But we also have AAII members that want to use all funds, die-hard index investors. That's great too. Chances are some of you are mixed, where you hold some stocks, but you're also supplementing with funds. Some of you do work with advisors. And so there's no right or wrong answer here. We want you to figure out where on the scale are you, because that really governs what's going to go in your portfolio. So if you're someone who says, you know what, I like the idea of analyzing stocks, but looking at balance sheets doesn't really excite me. I'm happy actually using AAII fund tools, the ETF tools, and the mutual fund tools that AAII has made available on their website. That's great, but that's also going to govern how you decide what goes in your portfolio. So the idea is, if you're someone who really wants to pick stocks, then that's what you should focus on. But if you're someone who wants to actually take the comfort of investing in funds, then that's the stuff you should focus on. And so it's really about clarifying who you are as an investor, so then you can start spending your time looking at things that are really appropriate for the type of investor you are. And so the idea is really just to create clarity of the type of investor you are. And then we want you to list your accounts. And the reason why for doing this before you actually figure out what goes into your accounts is to really have a sense of what you have, what you're paying in expenses, but also get an idea of what your accounts are. So when you start looking at filling your allocation and what goes in your portfolio, it gives you the opportunity to start thinking about asset location. So I've been talking a lot tonight about asset allocation. Asset allocation is, what types of assets are you going to hold? Asset location is, what types of accounts are you going to put assets in? And probably the biggest free lunch you can get in investing, and perhaps the only free lunch, is you can lower your tax bill if you're smart about knowing where you place certain assets. So with certain restrictions, the IRS is pretty much hands off about where you put certain assets. So if you have a mix of taxable and tax preferred accounts, you can really use it to your advantage. So your investments are very tax efficient. Your low turnover strategies like the shadow stock portfolio, your very tax efficient investments like your municipal bond funds or your municipal bonds, your muni bonds, your index funds. You could put those in taxable accounts because you won't really have a high tax cost associated with them. But say, for instance, you're engaging in active trading strategies, you're holding corporate bonds, perhaps you hold real estate investment trust. Those are not tax efficient. Those actually can give you a lot of income that's taxable at your marginal tax rate. Put those in your Roth IRAs, put those in your traditional IRAs. You'll actually save on taxes by doing so. So if you think about that, it helps you in terms of when you're trying to plug holes in your asset allocation about where you can actually locate certain assets. And then we want you to track your expenses. And the idea here is to have a sense of what you're paying on your investments. So if you do know you have certain investments that are higher cost, as you think about your asset allocation and what you may need to adjust and what holes you need to plug, you can also think about what you're paying expense ratios and where you may be able to cut expenses. Now, this is an example of a young couple we plugged in to give you an example. You can actually get this in a PDF format or an Excel format, and we'll actually give you the ability to plug in all your assets on this worksheet, your expense ratio, so you get a sense of what you're paying overall in your own portfolio. And it may point out investments you have or certain assets you have, such as maybe your 401k, maybe your IRA, where perhaps you are paying more in expense ratios than you realized. Maybe you're lucky you're actually paying less in expense ratios than you realized, but at least it gives you that knowledge to realize that as you're going through this process, you might find opportunities to find a suitable investment strategy or suitable mutual fund or ETF that fills an allocation but does it at a lower cost without really sacrificing return. Because while we think you should try to reduce expenses while you can, we also think you should really focus on the value you're getting. And so one of the comments I get, I'll just give a good example, is that what should I spend on when I manage my portfolio? And I suggest you spend on tools and services that help you make better decisions, that help you manage your portfolio better. So say I'm a big fan of stock screening programs, and obviously I'm biased towards Stock Investor Pro, but I do tell active investors, if you're going to be an active investor, use a stock screening program. And certainly there's competitors to SI Pro, but obviously I'm biased towards Stock Investor Pro. It's a great program for the money, but if you're an active stock investor, using a stock screening program can lead you to stocks you've never perhaps heard of, but match your criteria perfectly. And it doesn't take too many stocks that match your criteria and that do well to more than pay for it. So that's one of the things you should think about is the services I'm paying for, is it helping me? Am I getting that benefit? And if it is, then you can justify the cost. But when you look at something like a mutual fund, or say you're getting a fund that's a large cap blend fund, pretty much mimicking the index, you're paying a high expense ratio when you can get a similar fund that's, say, an index fund that's essentially giving the same portfolio, but for a lot less expense, then you're not getting value for your money. After all this, then start thinking about your portfolio composition and your rules. Write down what you're holding in your portfolio and why. Why are you holding it? What are your rules for doing it? What's going to prompt you to review the portfolio? What's going to prompt you to make changes to your portfolio? So in this case, in terms of large cap stocks, how much do you have allocated to it? How are you getting allocation to stocks? For this case, we use a hypothetical investor, a gentleman named Frank. He's using our value-oriented AAII stock screen. So he's using the stock screens available on our website to find value strategies. And he's also using our value grades. He's using our A+ grades. So he's buying these stocks when they're low value, but you start seeing this value grade, say, get from instead of A or B to D, that's going to be his sign to perhaps sell the stocks. They're also owning target date funds, he and his wife. If they notice there's an objective change in their target date funds, and that might prompt them to change the funds. So the idea is you have this really what I like to call a notebook, a guide, so that you not only know what you own, but you also have guidelines for why you're holding an asset, and a prompt to know what to look for when it comes time to review your portfolio. Now you could actually use My Portfolio to do the same thing. In My Portfolio, the portfolio tracking tool in AAII, we actually have a notes field on the portfolio. We can actually put notes right there with your portfolio. So if you're using My Portfolio, you could do that. We don't have this integrated into the website right now because we're still trying to develop the prototypes. We're seeking member feedback. So before we do all the heavy programming, we want to give you worksheets you can use, try out, and give us suggestions on how to make changes to it, because it's certainly a lot easier to make changes on a PDF or Excel document than it is to actually get our programmers involved. So what else do we have forthcoming down the road? Well, let me show you. These are just prototypes, so these are subject to change. For retirees, we're actually working on the withdrawal strategies. So I talked earlier about the 4% rule. I talked about Jim Clunen's level 3 approach. One of the big things with retirement withdrawals is that you really want to decide a strategy early on and write it down and stick to it. And there's a big disagreement about the proper withdrawal rate. There isn't. If you ask 5 people who are retirement experts about what you should do with your portfolio at retirement, you're likely to get 10 opinions. We're focusing on withdrawal on strategies that have been proven to work over the long term. We know there's data backing on them. And so we want you to write down your strategy, whether it's a 4% rule, whether it's Jim Clunen's level 3 approach. Both are very good portfolio strategies. Write it down. We'll give you the ability to track your RMDs, your required minimum distributions, because we know many of you have them. And there's actually much more to this worksheet, but the idea is you have a single sheet that allows you to track your withdrawals and really help you keep a sense of what you're withdrawing each year and help you determine whether or not you're on track. It kind of gives you an idea, should you need to adjust your withdrawals, you can see the data right there. Estate planning. And I think this is an important part about your financial management. So we've been talking so far about your allocation, about what's going to go in your portfolio, tax location, how you're managing your portfolio. Chances are many of you are hoping at some point to leave some money to your heirs, or at least have your heirs or at least have the people you trust be in a position to step in on your behalf should something unfortunate happen to you. This is where estate planning comes into play. Making sure that you're really that everything's set up the way you want to be. Your assets are set up the way it wants to be. You know, simple things like making sure your fiduciaries are up to date. Making sure there's a list of financial professionals. Maybe you work with a tax attorney. Perhaps you have an estate attorney. I can tell you from personal experience, the fact that I knew my in-laws' estate attorney, and the day after my father-in-law passed, the day I was able to give her a call and say, hi, this is Charles, I wanted to show you the bad news, was an invaluable to actually have that conversation with her and start that process of what to do. I also put on there, you'll notice, doctors. And you might think, well, why is he putting doctors? You're talking about portfolio lists. I really want you to think about this is a list of all the important contacts. Should something happen to you and you're unable to manage your portfolios, what information will the people you trust need to know? And if you're putting this list together, maybe you want to think about the other important contacts. You know what? By the way, since I have this list of important contacts, here's a few other people you should call. So instead of having all these estate planning documents disparate it, why not put it into it and realize, you know, lists like doctors, close friends might not have anything to do with your portfolio planning. But if you're thinking about a list of documents you can give to the people you want to have that you really trust, having that in one place actually makes their lives a little bit easier. So that's my logic for it. And then obviously having a systematic process for reviewing your portfolio. How frequently are you going to review your portfolio? You know, this idea, what are the things are violating your sell rules? Has there been a change in strategy? And, you know, the idea is you can change this up, but the idea is you actually have the systematic portfolio review process, something written down, so when it comes time to review your portfolio, you're not waiting to hear whether Jim Cramer's yelling buy, 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 or sell, sell, sell. You actually have this process so that every time you sit down to your portfolio, you're going through steps A, B, and C to actually review your portfolio. So every time you sit down to your portfolio, it's the same process over and over, governing whether or not you need to make a change or whether you do not need to make a change. So we're actually going to create this as part of the AAII Way. So you have everything completed. You start with your goals, it goes through your allocation, how your portfolio is managed, what's in your portfolio, what, you know, your list of important contacts, and then when it comes time to my portfolio review process, here's what's going to be. And part of that review process is going to be, by the way, check your fiduciaries and make sure that their contact information is up to date. And finally, a reminder to actually review what's going on in your life. So when you get to the review process, you can almost think of it as two forks. One, something's changed in my portfolio, something's changed in my allocation strategy, I need to go back and change things. But the other thing is, there's been a change in my life. And if there's been a change in your life, something positive, hopefully not, but perhaps something negative, you can go through and actually consider whether or not your tolerance for risk has changed, maybe your goals have changed, and just having this little checklist to go through and ask yourself, has anything changed in your life? It can be a nice prompt to get to remind you, like, oh, I didn't think about that. I really should use this as a reminder to perhaps change my fiduciaries, change my tolerance. Maybe I need to think about incorporating my new grandchild's, college into my goals and allocate according to that. And finally, we're going to give you a document to put everything together, so everything's comprehensive. Your investment policy statement that governs everything you do. And so again, you can see everything we're creating for the AAII Way, AAII.com/AAII Way. You can see the worksheets are very created, the commentary, and as we take these prototypes and develop them into new worksheets, you'll be able to see them there as well. John, are there additional questions I can answer?
Yes, Charles. I mean, most of the questions that have been coming in have to do more with the asset allocation part of the presentation, which was the first half. One comment that a member had in using the worksheets is that he would like more space for listing all of his accounts in them. So if you develop any further versions of this, if you could make them expandable in that regard, that would be a request made by this one individual. And how much time should we allocate for additional questions, Charles?
What time is it? It's about, we'll allow about 10 or 15 minutes. I know it's getting a little bit late for some people, so we'll go about 10 or 15 minutes.
Very good. This is almost a follow-up question on the first question we asked tonight. And you had a couple of recommendations regarding the stock market. Do you have any books you'd recommend regarding bond investing for someone who wants to get more familiar with that process?
There are a couple books. We'll actually put them in the show notes. I'm drawing a blank off the top of my head, but we will make sure that in the show notes. We actually have books that are more accessible to individual investors.
Yeah, the challenge with bond books, and Charles and I both, studied for the CFA exams, and most of the books that have to do with bonds were written by Fabozzi, and they're very deep books. They're very knowledgeable, great information that's expressed in them, but probably a little bit past what most individuals want to read. I see Charles reaching behind his back now, looking for one of the true Bibles when it comes to fixed income investing. But one of the things about the association is we actually have a wonderful staff that helps Charles and myself put on all these webinars. And Jean has been, I'm sure, tirelessly sitting there writing down all the information. So tomorrow when we send out an email that provides a link back to this video, we'll have in there any kind of book recommendations that Charles has, information that might have come up over the course of tonight. So tomorrow we'll have a link to our handouts, plus any additional information that was mentioned during the webinar tonight. Let's see here.
I just want to point out that for y'all reading the journal, the reason why it's so well put together, Jean, Annie, and Neen run our editorial staff. They do a great job with the journal, so I just want to give them a quick shout out and some credits.
Yeah, well deserved as well. So a couple of questions have to do with the issue of moving money. So if they're, have picked up some cash and they want to know how much time to get allocated, or if they're moving from one type of allocation to another, is there a recommended amount of time they should take? Should do it at once? Should they spread it out? Are there techniques they can use?
Yeah, there really isn't a time horizon to do it in. One of the considerations is if you're in a taxable account, then you really want to, you're trying to make a big change in allocation, then you really want to take the tax consideration into account, because you may want to actually spread it over a period of time, or at least into different tax years. So that would be one consideration. But if you can do it an account that's tax preferred, it's really a matter of when you're comfortable. But if you're nervous about making the change, And I do get this question even about getting back into the market. Well, I would say if you're nervous about timing, just pull out a calendar and circle dates at certain intervals. Perhaps you do it a little bit every month, perhaps it's once a quarter, but the idea is that they're equally spaced apart, and when that date happens, no matter what's happening, you do it on that date. So again, no magic number, but I would suggest, either all at once at just tax considerations and maybe spread it out so you don't take a big tax in 1 year, or again, using this calendar focus where you have an interval that you just pick and you just go on that basis.
And an article regarding value averaging, is that of any interest to our members, perhaps, in this question?
Sure, we're actually going to have that appear come up in October issue.
And so it basically, it's a bit of, basically putting money into items that are underweighted because they've gone down in value, and perhaps taking money out or not directing money to those items that are a bigger part of your allocation. Is that a fair way to assess that?
That's a very good way of assessing it, absolutely.
Excellent. A couple of members have asked regarding, in our asset allocation models, we don't really segment growth or value. We just simply say large cap or small cap. Any thoughts about how one should potentially consider that part of their allocation?
Yeah, it's interesting because next week Larry Swedroe is going to be our guest, and John will be moderating again. And I just happen to be reading Larry Swedroe's book, I think it's called The Incredible Shrinking Alpha. And he talks about diversification. And so he does actually encourage people to think about diversifying not only by asset class, but also thinking about factors such as size and value. Our allocation model really is set up to think about in terms of just blended funds. So your S&P 500, your S&P small cap 600 index is really market indexes, and that's what the returns are based on. But I do think there's a lot of room within there where you could actually take advantage of factors that go into it. So to take a look at our portfolios, for instance, to use as an example, our dividend investing portfolio is very oriented towards large cap dividend paying stocks. You could hold that for the large cap allocation. For our small cap, you could use our shadow stock portfolio. So in this case, you're getting your income paying stocks from your large cap allocation. On your small cap side, you could be having our small cap value. And then if you want to plug things in between, you could be looking at, say, our stock superstars or VMQ portfolio or VMQ stocks portfolios, which are really market cap neutral portfolios. They'll give you a blend of large cap, mid cap, and small cap stocks. So that would be one way to do it. But obviously, if you have a bias towards, say, value, or perhaps you have a bias towards growth, you could potentially plug those holes in with those tilts.
Your comments about bonds have sparked interest from a number of our members here, and they'd want a little bit more color if you could. Two questions that have kind of come up is the pros and cons of bond laddering versus owning a mutual fund, and can you discuss a little bit, some of the issues that impact how sensitive a bond is to change in interest rates?
Sure, absolutely. I'll start with that second question, how sensitive it is. So it's really a function of what's known as duration. A simple way of doing this without reaching back for that tomb of a book on bonds, a simple way to think about, and we can actually, there's some great articles about bond duration that we'll have Gene link to in the show notes. But basically, the farther out a bond is from maturity, the more sensitive it is going to be to interest rates. And so the reason why is, say you have a bond that's yielding 5% and current yields are 4%. Well, people are going to want that bond that's paying 5%. Now, say that bond's paying 5%, but all of a sudden yields are now 6%. Well, all of a sudden, if I can get a bond now paying 6%, that bond that's paying 5% is less valuable for me, so I'm actually going to say it's priced less. I'm actually going to want to pay less for it. Now, if I know I'm going to buy that bond that's yielding 5% in a 6% interest rate world, but that bond's going to mature, say in 2 years, I might be willing to hold on to that bond because I might say, well, interest rates are 6% now. they seem like they'd be trending up, but you know what, in 2 years, I might get a higher interest rate. And it's not worth me selling it right now just to get 1% interest rate, 1% extra interest rate for 2 years. But now, if that 5% bond doesn't mature for 20 years, I might be looking at that thinking, well, if interest rates are going to go from 6 to 7 to 8%, I don't want to be holding this bond now for 20 years. I might want to get out of it, and that creates some selling pressure. So that's a very simplistic way of explaining how duration works and how bond interest rate sensitivity works.
And you would, I guess, to summarize that, you would say basically the lower the interest rate, all the way down to a 0 coupon, the more volatile or more sensitive a bond is, and the further out to maturity, the more sensitive a bond is to changes in interest rate. Those are the two primary factors that impact the sensitivity. Is that a fair assessment?
That's a very good way and concise way of saying it.
And then the other question, the advantage or disadvantage of a ladder versus owning a bond mutual fund.
So with a ladder, if we're talking about individual bonds, realize you do have to buy individual bonds, and that requires having a pretty sizable amount of wealth to actually invest in it.
Bonds, you can invest in treasuries pretty easily.
Right, you can't, excuse me, that's right, you could invest in treasuries. So you're right, if you're looking at muni bonds, which I was thinking in my mind, that requires a pretty sizable amount. You could actually invest in treasuries directly through treasury.gov, as John pointed out. In this case, you're owning individual bonds. You are taking individual bond risk. Now, with treasuries, the government has never defaulted. You do tend to get lower interest rates, but you also then required to manage the ladder. It's up to you as those bonds mature. It's up to you to then reinvesting it. With bond funds, you have a manager that's doing all that work for you. The difference is you have no control over what's in the portfolio. You have no control of when the bond manager is making decisions. And with bond funds, you do have two things that are affecting its value. One is a change of interest rates relative to how the portfolio is set up, and B, how investors are reacting to that bond fund. Are investors deciding to pull their money out, which could cause a bond fund to not only have outflows, but those outflows can only hurt the bond's performance, but also potentially result in capital gains that are then distributed to you. So you don't have control over the tax aspect in addition to the bond fund. So you lose control, but it gives you some ease as well. So that's a trade-off. With the defined maturity bond funds, you get a hybrid where you don't have to be as involved in the portfolio. You can stack them, but you also don't have full control over what's in the bond fund itself either.
A question here that's kind of interesting, why not just simply invest in a total stock market fund as opposed to allocating parts of your portfolio to large cap, mid cap, small cap, and international?
It really comes down to how much specific exposure you want to those asset classes. So if you're buying a total market fund, yes, you'll get some mid cap exposure. Yes, you'll get some small cap exposure. But by and large, that's going to be tilted towards your largest assets, particularly a market cap weighted extended market fund, a total market fund. So you're waiting on that's going to be towards your largest stock. So you're getting a lot of exposure to really what's known as the beta or your market premia, your large cap premia for the market. So if you actually split your portfolio up according to your asset allocation, you start giving yourself exposure to small cap, to mid cap. And it's worth noting when you look at the 20-year performance of the mid cap, we start with the moderate allocation. The allocation that actually did best over that last 20-year period was mid cap stocks. Now, there was only, I believe, 1 year where mid cap stocks were the best performing asset class over that 20-year on an individual year, but over that 20-year period, mid-cap stocks actually had the best performance. So by allocating specifically to mid-caps, in this case, 20% to mid-cap, 20% to large cap, in our aggressive portfolio, you actually had equal weighting to both. So that's where you actually get the benefits. However, you do not get the ease of having all your exposure in a single fund, which can be less work for an individual investor. So you give up some in return, but you do have the ability to say that I just bought this one fund and it gives me total exposure.
Any thoughts on how real estate, commodities, or even alternative investments fit into the asset allocation?
So we stuck with stocks, bonds, and cash. Lots of long-term data on them, how they work, makes things easy for investors. With real estate, it tends to, over a longer period of time, it tends to be less correlated with stocks and bonds. It is an equity allocation. It does seem like over time, however, the evidence does seem to suggest it's getting more allocated towards stocks. It really sits outside our allocation, but if you want to think about it in terms of equities versus bonds, it is an equity investment, so it would fit into an equity allocation. And you could really add it as another asset class that's a mix of mid-cap, small-cap, international. As far as other things, commodities, I'll bring up gold. Gold as an asset class does tend to be uncorrelated with most other assets. And I know other assets, it tends to be uncorrelated with stocks, tends to be uncorrelated with bonds, tends to be uncorrelated with real estate. So it does offer a lot of diversification properties. The problem with gold as an asset class, its returns really depend on what period you look at it. So it has a reputation as being a hedge, but how good a hedge it is, even against inflation or market volatility, really depends on what period you're looking at. So yes, it's uncorrelated. Will it actually give you the protection you desire? Really depends on what period of historical returns you're looking at, because you could make an argument that the answer is absolutely yes. You could easily make an argument the answer is not really. So there is an argument for having commodities and gold being in it. Craig Ilderson is going to make that argument in the September Journal. But my personal viewpoint is it's really not necessary. I will say at a high level, get that mix of stocks, bonds, and cash right first. And then if you want to think about commodities as a diversifying agent, you could. But make sure you get the first three big ones right and that you can do that correctly over the long period of time.
Well, I probably only have time for a couple more questions here. So let's see here. Actually, these are probably we've gotten a couple of more comments than questions, but you know, it seems like including information such as significant contact and login information should be part of whatever you pass on to significant others. Any thoughts about that?
Yeah, it's interesting. I did have another member suggest that. I do keep a list of notes of what people are suggesting. So that was that actually was for another member. So yeah, we'll definitely put that note in there.
Very good. Let's see what else we have here. Sorry, I'm looking for questions we haven't answered yet. Actually, you know, this is not so much a question, which is a comment. And again, it's giving you kudos, Charles, for a great webinar. And he thinks it's the best webinar he's seen here at the association year to date. So, and it's the name is not tied to your last name, so it must be a true member.
Well, that's very kind words. I very much appreciate it. Thank you.
You know, with brokerage rates going down as far as price, how should one evaluate costs of trading and deciding whether or not you should make a transition from one stock to another? What factors come into play nowadays as far as deciding when to buy one security versus another?
Yeah, certainly the elimination of commissions has really been a game changer in terms of cost. You still have situations with bid-ask spreads. You do have some transaction costs. Those are harder costs to actually measure, particularly for an individual investor. Say, for instance, we're buying a small stock, say like a shadow stock, a stock that maybe has a market capitalization of maybe $150 million. And has low trading volume. it's really hard for us individual investors to determine whether or not our buy caused the price to move. So those decisions are really hard to factor in. If you're doing a taxable account, you certainly can factor that into it. But yeah, I do think that the elimination of brokerage commissions have really taken out that component of transaction costs, and that is a big win for investors. Certainly on the mutual fund side and on the ETF side, the fact that we're seeing expense ratios drop, that's lowering their costs, that's putting more money in our pockets. So I also think that's a win for investors. But I think the cost of going from one stock to another in a no transaction, no commission world, presuming you're doing this in a tax preferred account, it almost comes down to behavior and your sell rules. And are you selling because the stock has actually violated a sound rule? Are you selling because you just think the other stock looks attractive?
A couple of comments here or questions. So if a member has a general question about their membership or information they want to get about any of our products, what's the best way for them to contact us?
Absolutely. On AAII.com, if you get to the website, it actually has a list right there that says contact us. You can click on it. It has our phone numbers. It also has a form where you can actually fill it. It'll email it to us on it. We also have various contacts, but that's where I would actually suggest to people. Also, in each issue of the journal, if you look at the table of contents, we have our phone number listed right there. Even though we are working remotely, our member services staff is doing a great job. They're monitoring phone calls. They're ensuring that member questions and member needs are getting attended to. And if there's something they can't answer, they're obviously passing it on to me and others in the organization who can answer those questions.
So if I could add to that is that we have installed a new phone system, I believe, this past week. So we should be able to answer your calls more directly now and more quickly than we have in the past since we were working remotely from home. And if you have a general question, I think members at AAII.com, we now are trying to route all member emails through there, and our member services department will try to make sure that it gets answered in a quick fashion. Another question, I guess, has to do with, we've mentioned the shadow stocks, and what's the best way for a member to find out the rules of the shadow stock or to see the shadow stock portfolio on our website?
Yeah, absolutely. So they will be in the AI journal. You can see them there, but if you actually go to our website, you'll see a link right at the very top. And John, I'm telling you, an absolute blank right here on the website. You can help me out here.
Yeah, it actually, what's going to happen in the next course of the next month or two is we're going to add a new link on our main AAII website menu. It's going to be called Model Portfolios. It'll be listed there. Right now it's listed under subscriptions.
With you. And you can actually see at AAII.com/model-portfolios, and that will take you to the page as well.
Thank you. So with that, Charles, I know we've gone hour and a half here, but why don't you tell us a little bit about the upcoming webinars, if you have a slide for that?
Absolutely, I do. I'll go right here to it. So as I said, next week we'll have, and I'll apologize to Ryan, I think he was going to do this. I'll take it.
That's okay, Charles. Go ahead. Go for it.
So Larry Swinder, who I mentioned earlier, he's going to actually talk about what to do when an investment strategy performs poorly. John will be moderating that. The week after, on September 9th, Jack Vogel with Alpha Architect will be talking about quantitative momentum, which is a systematic process for identifying high momentum stocks. I'll actually be speaking with Jack. Larry and Jack are both great speakers. I think you'll enjoy both. And then speaking of great speakers, John's and my colleague, Wayne Thorpe, he'll be talking about how to invest like a stock superstar on Wednesday, September 16th, showing a fundamental and technical approach to seeking growth. I believe my colleague, Derek Hageman, will be moderating that. You can register for all of them at aai.com/webinars. You can also see the show notes and recording of this webinar, plus all the other webinars we've done beforehand.
Thank you very much, Charles. Brian, take it away.
All right. Well, I wanted to thank everybody for joining us on tonight's webinar. I know we did go a little bit long, but we answered a lot of great questions, and thank both Charles and John for their time tonight. We do love educating our members and individual investors. So thank you, everybody, and I hope everybody stays safe. Good night.
Thank you. Good night.